Welcome to today's market report. European stock markets traded in a mixed fashion, with investors reacting with caution after a suite of US Federal Reserve officials hinted that it could start reducing its monetary stimulus later this year. Three regional Fed presidents, Richmond's Tom Barkin, Atlanta's Raphael Bostic, and Dallas' Robert Kaplan, all hinted more or less clearly on Monday that the tapering of bond purchases could begin toward the end of 2021. The Fed is currently pumping $120 billion a month into the economy through such asset purchases. DAX in Germany traded 0.3% higher, CAC 40 rose 0.1%, FTSE dropped 0.1%. Global equity markets have posted strong gains over the last few weeks, boosted by stimulus from central banks and governments alike, and the idea that vaccinations were on their way. This tone was helped by the prospect for additional US fiscal stimulus after a Democratic sweep of Congress, with President-elect Joe Biden pledging Friday a new economic stimulus in the trillions of dollars. However, investors are now starting to weigh up whether valuations are becoming too stretched, especially with a global surge in COVID-19 cases following the emergence of new highly transmissible strains of the virus. That's posing fresh challenges for governments that are still only in the early stages of vaccination campaigns. Additionally, political uncertainty has increased. The US Democrats introduced a resolution into House of Representatives to impeach US President Donald Trump, accusing him of inciting insurrection following a violent attack on the Capitol by his supporters last week. Back in Europe, BMW stock fell 0.2% after the German car manufacturer said it saw a 8.4% drop in vehicle sales in 2020 as the outbreak of the coronavirus took its toll. Volkswagen stock fell 1.2% on the report of a general recall or new Golfs. In the UK, online retailer The Hut Group raised its guidance for the coming year and now sees revenue growing as much as 35%. THG stock rose 1.7% to a new all-time high. Oil prices edged higher on Tuesday ahead of the publication of reports concerning US oil stockpiles from industry group American Petroleum Institute later. Crude futures traded 0.9% higher at $52.71 per barrel. Brent rose 0.8% to $56.11 per barrel. Gold futures rose 0.3% to $1,856.10 per ounce. On the FX front, GBP/USD recovers further from Monday's two-week close amid a subdued US dollar demand. The pair refreshed daily tops around the 135.65 to 70 region in the last hour, albeit quickly retreated a few pips thereafter. The pair was last seen trading just below mid 135, up around 0.25% for the day. The US dollar was seen consolidating its recent strong recovery gains from the lowest level in nearly 3 years and was seen as one of the key factors behind the intraday uptick. Bank of England Governor Andrew Bailey spoke on the topic of negative interest rates. He commented, "Negative rates are a controversial issue. There are a lot of issues with negative rates. No country has used negative rates in retail and of the financial markets. There are good reasons to think we are in a world of low interest rates for a long period of time. Outlook for interest rates hinges on productivity growth." The pound picked up fresh bids on the back of the expectations, driving the pair GBP/USD back towards the daily high of 135.68. Goldman Sachs analysts bet 4-1 odds on a surprise move of a Bank of England rate cut next month. The possibility of a 10 basis points rate cut, taking the bank rate to zero, suggests positive rate risk reward in betting on lower OIS rates at February meeting, said Goldman. Eurodollar looks for direction around the 120-150 region. The downside pressure on the single currency appears mitigated so far, on turnaround Tuesday and motivates Eurodollar to hover around themed 121s in the wake of the opening bell in Euroland. Eurodollar is attempting to finally reverse 3 consecutive daily pullbacks and spark a more serious rebound after bottoming out in 3-week lows near 121.30 at the beginning of the week. Indeed, the persistent and renewed buying pressure surrounding the greenback forced the pair to recede from yearly tops in the 123.50 region, shedding at the same time more than 2 cents in just 3 sessions. The dollar had hit a more than 2.5-year low in January after sliding for a month, as ultra-dovish policy from the Fed encouraged investors to seek alternative currencies. The dollar index was at 90.438, above lows of 89.206 hit last week. This is today's market news. Thanks for listening. We'll see you next time.